All right, guys, like I was saying, welcome to our second live lecture. With this week, like I was explaining before I hit the recording, this can be one of the more frustrating chapters if it's the first time you're going through accounting, because this is when you're going to see debits and credits, normal debit balances, normal credit balances, which side of an account increases, which side decreases, et cetera, et cetera. And if you did the discussion, which I saw Monica, looks like you're having trouble downloading that video for the discussion. I take it that's what you're talking about. And it looks like, Elizabeth, you had issues with last week's lecture. Okay, so first, the lecture, they should always be located in the announcements. So, for instance, with my classes, let me get rid of that. You see, I have week 1 recorded lecture, and I send this to all the other professors so they have the lecture. In fact, no, that's right. I upload it to YouTube, and they probably give you the link. So you can see me. I post it in my class, and they can do this as well. So if you're in my class, you'll just see week 1 recorded lecture, and you hit play. Now, the other professors, I upload it to YouTube, and they can download it. So if I go to... If I go to YouTube and type, this is probably what will come up. I kind of figured I was going to get a lot of results, so let's do this. So here's week 1's lecture. You can see it's uploaded right to YouTube, and week 2's lecture will also be uploaded. And depending on, excuse me, what your professor does, if they post the link in their announcements, they might do that. Or like I said, with me, I just post it, the whole lecture, right in the class. Yeah, it's really strange. I knew there was issues at the beginning because I actually really don't upload anything to YouTube, so this is one of the first times doing it, but I accidentally had it marked as private instead of public, but I changed that like probably once we found it out like last week. But yeah, hopefully it's working now and everything, and hopefully this next one that I upload goes a lot smoother. But yeah, it's right here, the week 1 lecture. And like I said, with my classes, I just post it right in the announcements as well. So let me get out of that. And actually a few more people came in, so let me just mark them down for attendance real quick so I don't forget. Okay. So this week, like I said, we're going to look at more in depth in the accounting with debits and credits. This is probably the most important chapter because this is all the fundamentals of accounting that build into everything else in accounting. So similar to last week, you have your discussion, your assignment, and your assessment, as well as your daily checkpoints. Daily checkpoints, 5 points a day. Keep up with them. I mean, they're pretty easy points, and if you do them all correct, if you do them all and you do them accurately, then you can get up to 55 extra credit points, plus just doing them will help your grade so much. So very important to keep up with those daily checkpoints. Your discussion, this one deals with talking about debits and credits. And there is a video, and I heard a mic. Let me just get that. There we go. And this deals with a video which should play. Let me see. Hopefully it just goes. Okay, so I'm just making sure it's working. And is there another video? No, there. Also view the recorded lecture video. Here it is. So both videos look like they're working. I just wanted to make sure on that. So with your discussion, it talks about these videos and understanding the rules of debits and credits. So there's neat little ways to remember it. And everyone remembers stuff differently. So come up, these videos might help you or they might be garbage to you. To me, I remember the best by seeing stuff over and over and just learning the concepts. Like I don't learn from doing creative acronyms or anything like that or songs, but other people learn very well and, find those ways easier to understand. Whereas me, I just try to understand the concepts and do the material over and over and over till I get the hang of it. But that's what I'm getting at. So you have to find the way that works best for you. So that's what this discussion focuses on. And again, remember with these discussions, your first post, 150 words by Wednesday with at least one citation in APA format. And let me just get that. There's another mic on. A citation in APA format, and then 2 replies to students of 50 words each by Saturday. So again, if you follow all that, you're free of grammar and spelling errors, and you focus on the topic, then you shouldn't have any problems getting a 60 out of 60. So that is your discussion for the week. And then you also have an assignment and assessment, which we will go over. I'll go over the assignment a little bit, and as well as the assessment after we do the PowerPoint, which isn't going to take long because there isn't that much to it. Not too many slides, that is. Here, another mic. Just get in the mics. That's all I'm doing. All right. So are there any questions before I hop into the... Oh, I also will have... I'm going to try to get all grades completed by tonight. I usually have them completed by Sunday, but Father's Day weekend made it a little hectic to get all that, but they will be completed, hopefully most of them by tonight, if not, definitely by tomorrow. If you guys are wondering why some of your stuff isn't graded. Thank you, and same to everyone else. Happy Father's Day. Hope they enjoyed the weekend. I'm sure you guys were running around as well. But any questions before I hop into the PowerPoint? All right. Okay, so there is probably a very important slide that I would say to memorize in here, which we will get to, and I'll point that out. I think it's the most important slide, like in all of accounting, just because, again, these are the fundamentals. So we learned from last week the accounting equation, assets equal liabilities plus owner's equity. Remember, assets are what you own, liabilities are what you owe, and then owner's equity is your financial interest, usually your financial interest in the business. Like I said, a good example to use is a house, a $200,000 house with a, let's say a $300,000 house with a $250,000 loan, but has $50,000 equity in it. That's a very good example to understand the accounting equation. So very important to know, again, assets equal liabilities plus owner's equity. And then these are what are called T accounts, and you also see this in the assignment. So T accounts represent your various accounts, and they each have a left and a right side, hence the name, T accounts. You can see it right there. Some accounts increase on the left, and some accounts increase on the right. In this is what I was talking about memorizing. Assets, they have what's called a normal debit balance, which means they increase on the left side. They decrease on the right. Liabilities in equity are the opposite. They have a normal credit balance, which means they increase on the right side and decrease on the left. So anytime you hear normal debit balance, that means the account increases on the left side. Anytime you hear the phrase normal credit balance, that means the account increases on the right side. And you're also hear debits on the left, credits on the right. That's something you should always remember as well. Debits are on the left, credits on the right. And we'll see this on another slide as well, with the debits on the left, credits on the right. So steps to analyze transactions. The first step is to analyze the financial event. Identify the account affected, classify the account, and determine the amount of increase or decrease for each account. So for instance, if you have a check that you wrote for rent, I paid rent for $500, issue check 1120 for $500 for rent expense. Well, you'd identify the accounts affected. So in this case, your rent is going to increase because it's an expense. So you're recognizing your expense, and your offset to that, remember from last week, when you issue a check, it affects cash. So your two accounts affected are going to be rent and cash. And I'm getting ahead of myself a little bit here because we didn't discuss expenses, but expenses have normal debit balances. So you would debit rent for $500 to increase rent to recognize expense, and then you'd credit cash for $500 to decrease the cash, because cash is an asset. Assets have normal debit balances, which means they increase with debits, but in this case we want to decrease it, so we want to credit cash. Whereas expense, they have normal debit balances. In this case we want to increase rent, so we debit rent. And that's probably a lot to take in right there, but it will make more sense as I get to the homework and through these slides. So recording account balances, and this is basic math. I will get the recorded, Dennis, I'll get the recorded posted right after class, and I'll also I'll upload it to YouTube and shoot the link over to the other instructors. So mine will be posted right after the class ends, probably 9:15, roughly 9:30 or somewhere around there. I'm thinking Eastern time, but no, that's more than all right. But yeah, I'll get it posted and then also shoot the YouTube link over to the other professors. But no worries. So account balances, recording them in the T accounts, because you have to balance the T accounts at the end. And this is basic math. If the total on the right side is larger than the total on the right side, then the balance is recorded on the right. Sorry, just muting and recording to make sure I get everyone's attendance. So for instance, like if you have $10 on the right side and $2 on the left side. Well, if you take 10 minus 2, you have 8 remaining. Since the amount on the right side was bigger, that means what's left is on the right side, $8. Same thing with the left side. If the total is just on the left side, the total on the left side is larger, then the balance is recorded on the left. An account shows only one amount, that's the balance. An account contains entry on only one side, then the totals of that entry is the account balance. And that's what this is showing here, this next slide. You can see you have various account balances. You have your assets, your liabilities, and your equities. You have 100,000 in debits, 17,000 in credits. So 100 minus 17 equals 83 balance. You only have 1,500 here, so that's your balance. 8,000. You have 5 and 6 here, so that's 11. You have 6 here, 2,500 here, so 6 minus 2,500 equals 3,500. And you can see here there's only 100,000, so that's your balance. And down here, this is showing the summary. 83, 83, 15, 15, 8, 8, 11, 11, totals 103,500. Then your liabilities, your equity, and you can see assets 103,500 equal liabilities 3,500 plus 100,000. So totaling the T accounts, you can see it's very basic math doing it that way. So now this is probably one of the most important slides of this PowerPoint. Not the most important, but probably second most important. So the rules of debits and credits. A debit is on the left, a credit is on the right. And every transaction, because this is a double entry accounting system, has to have at least one debit and one credit. So when you're doing accounting, when you're doing the homework as well, you should have at least one debit and at least one credit, and they should always equal. You can have more than one of each, but you have to have at least one. So for instance, you could have 20 debits and only one credit, but as long as you have at least one and they equal in total. So you could have like debit rent, debit legal expense, debit equipment, and then credit cash for the full total, but you must have at least one debit, one credit, and they must equal. Very important to know. Yeah, the PowerPoints, in fact, I forgot to mention that. They are located right under Week 2 Reading and Tools, and it's right here, Chapter 3 PowerPoint. And there's also a video here as well. So yeah, this PowerPoint is located right here. I apologize for not mentioning that. So again, debit on the left, credit on the right. Debits must equal credits, and you must have at least one debit and one credit. And that's always your check. Even when doing the homework, you'll see when you do the transactions, you should always check, do my debits equal my credits? And do my assets equal my liabilities plus owner's equity? If they don't, then there's something wrong. And then the next slide is again just emphasizing debit on the left, credit on the right. So again, left side is referred to as the debit side, right side is referred to as the credit side. And here is the most important slide of the chapter, and in all honesty, probably all of accounting, because again, this is the very basics that all of accounting build off of. So you have that's fine, Laura. Like I said, that's why we have the lectures and everything. It's not a problem whatsoever. So, and this was a slide that it was earlier in the chapter, but this one's more in depth. It has your drawing, revenue, and expense accounts. So this lists all of your major account classifications, and they should look familiar from last week. Your assets, your liabilities, your owner's capital, your owner's drawing, your revenue, and your expense accounts. Assets, owner's drawing, and expense accounts. These three, 1, 2, 3. They all have what's called normal debit balances. So they increase with debits, you can see. Liabilities, owner's capital, and revenue are the opposite. They have normal credit balances, which means they increase with credits. Very important that you memorize these, which isn't difficult to memorize, but again, it's easy for me to say because I can say this stuff basically in my sleep because I've seen it for over 10 years constantly. So if this is the first time you're ever seeing it, it might look like Greek to you, but like I said, if you have, like I said, the videos have unique ways of memorizing this, like with acronyms and songs. Me, I just, like I said, just memorized it and constantly seeing it over and over is how I learned. So again, assets, owner's drawing, and expense accounts have normal debit balances, which means they increase with debits. Liabilities, owner's capital, and revenue accounts have normal credit balances, which means they increase with credits. I'd probably recommend to have, when you're taking the assessment, to probably have this PowerPoint up, but probably be on this slide because it will help you a lot. And then the last thing we're going to look at is a trial balance, preparing a trial balance from T accounts. All a trial balance is a listing of your accounts and their balances. So let's just go to the next slide. This is what a trial balance looks like. You can see it has a company name, title, date. It lists all of your accounts. You can see your assets, your liabilities, your owner's equity, owner's capital, owner's drawing, your revenue accounts, and your expense accounts. You list the balances, whether they're debits or credits, and then you total them, and you can see total debits equal your total credits. So trial balance, all that is a listing of your accounts and their balances. And this is the first thing that auditors will ask for is a final copy of your trial balance, because what they'll do is they'll get your trial balance, which again lists all of your accounts and their balances, and then from there they'll work backwards after digging into your accounts. Fees income, yeah, that is a revenue account. Is that what you're asking, Monica? It's just another name for it's just another name for revenue. Typically, you would see this as probably something you're more familiar with is sales, or a lot of time people will just call it revenue. But in the examples in the book, they use fees income, which is revenue. It's a revenue account. It's like I said, you can name it anything: sales, revenue. What other names could you name revenue? There's all kinds, but typical one is usually sales. And the last slide, which is what we saw from last week as well, is your three financial statements: your income statement, statement of owner's equity, and balance sheet. Remember, income statement shows revenue and expenses, which gets to your net income. And then your net income is rolled up into your equity section. So your beginning capital plus net income minus withdrawals equal your ending capital, which then your ending capital flows in to your balance sheet, which shows your assets, liabilities, and equity accounts. So the first financial statement you create is income statement, then statement of owner's equity, and balance sheet. And like I said last week, the two main financial statements that every business looks at is income statement and balance sheet. Statement of owner's equity, essentially what this is just the detail of the owner's equity account on the balance sheet. Like in QuickBooks, you would drill down on this and it would bring up this detail. But typically, a lot of companies don't build a statement of owner's equity account. The other account, like I mentioned the other financial statement that every business looks for is statement of cash flows. I swear they constantly ask for that. But that is it for the PowerPoint. Do you guys have any questions? Anyone confused? Makes sense? Somewhat sense? Extremely easy? Well, that is all good news then. So you guys are going to be experts at the homework. So I don't even need to go over the homework or the assessment. We can just end the lecture right now, right? I thought I would get a lot of those reactions. I'm just joking. That's my attempt at humor. All right, so let's go into the assignment. Let's get some of, and in fact, let me leave up the PowerPoint. Okay. Let me actually get rid of this too. I have too many things open. All right, so the assignments. It is 120 points like last week's assignment, and once it eventually loads, there it is. You can see here's the template you have to complete. And there are two parts to it. The second part of this, you have to utilize, you can see part one, you have to determine the account type, asset, liability, or owner's equity for each account name listed in the Excel. Identify normal, debit, or credit balance. So for part one, you would go through these and say whether they're asset, liability, equity, revenue, or expense, and whether they have a normal debit or credit balance. For the second part, you're giving transactions, and you have to, each transaction is separate from the other, and again, we'll go over them, some of them, and you have to post these to their various T accounts. So remember, in each one of these transactions, you have to have at least one debit and at least one credit, and your debits always have to equal your credits. Plus, after each transaction, your assets should always equal your liabilities plus owner's equity. And to help you out, anything highlighted in yellow should have an amount in it. And these amounts, the ones that have an underline above them, those are just the total columns. But again, everything in yellow should have an amount. So the reason why I said I'm going to leave up the PowerPoint is because, actually, don't need it right now, but I'll start going through. So for the first part, accounts, I'll do the first few, and then we'll do some together. So accounts payable, this is a liability. Because remember, accounts payable is what you owe someone. And accounts payable, since it's a liability, remember back from this slide right here, liabilities, they have normal credit balances. So that means this would have a normal credit balance. Accounts receivable is opposite. Those are assets because that is what you own. And again, back to this slide, assets have normal debit balances, which means they increase on the left. So they'd have a debit balance. So what about the next one? Cash. What account is that? And do they have a normal debit or normal credit balance? Asset debit, exactly. Yep. Asset debit. That's exactly right. Asset cash is an asset. And assets have a normal debit balance. Same with computer equipment. Laura beat me to it. Yep. Asset, debit. But what's fee income? Remember, you can pick from asset, liability, equity, revenue, or expense. So fees income is a what? Revenue, credit, exactly. Exactly, Melissa. Revenue, credit. What about J. Jones Capital? What is that one? These are the ones that tend, oh, no, got it. Owner's equity, credit. Yeah, these are the ones that can be a little confusing, but the capital account, remember, that's an owner's equity account. You have two owner's equity accounts. They're capital and drawing. So your drawing is also an owner's equity. But remember, drawing has a debit balance. Now, a lot of people get confused on why the drawing has a debit balance. But remember, these two, capital and drawing, net against each other. So if I have capital of $50,000 and my drawing is $5,000, that drawing reduces the capital account. So that's why they're opposite and why drawing increases with debits. So when you draw money out, you increase that account to show, hey, I took $5,000 of cash out of the business. Well, if I took $5,000 out, that has to reduce my investment in the business. So that's sometimes a little difficult for people to grasp, because a lot of times companies won't use a separate capital and drawing account. Instead, they'll just have capital on their books. They won't even have a drawing account, but a lot of times they do. It just, again, depends on the company. Office furniture and prepaid rents, they are both assets. So they increase with debits. But what about the last two? And I'll give you a hint, they're both the same. But what do you think rent and utilities are? Exactly. It's right in the name of the account, expense. They are expense and they are debit balances. Exactly. So that is your first part of the assignment. Any questions on that? Okay, so let's move into the second part. Let's do a few of these together. I'll do two. I'll do the first two. Yeah, the drawing account can be, that's why I always like to go over that, because that can be a little confusing. Because you have to think of it as like a contra account to the capital account. So I'll do the first two with you guys, and then I'll let you pick two more. All right, so third one on the assignment. So first come, first serve. So we got one. What's the next one that we're going to do? I'm going to do the first two, and we're also going to do the third one. But what is the last one? Okay, third and last one. Oh, I will do the 17th as well. So I'll do third, last, and 17th. All right, so let's do the first one, the third one, the 17th, and the last one. So I'll do the first one. So Jay Jones visits her local bank and withdraws $50,000 from her personal savings account, depositing the cash into a new bank account in the name of the business Smith Consultants. So you're starting a business and you take $50,000 of your own money and put it into the business bank account. So again, remember the rules of debits and credits. You have to have at least one debit and at least one credit. So based on that information, just think of it from your own personal standpoint. Oops, wrong one. If you put $50,000 into the business, which account is going to increase? So you're putting $50,000 cash into the business. Right, capital is one, cash and owner's equity, exactly. Cash in the capital account, exactly. So you're putting $50,000 cash into the business. So you're going to debit cash, because remember, cash is an asset. Assets equal with debits. So we want to debit cash. And then the offset is capital. We're going to credit capital for $50,000 because capital accounts have a normal credit balance, which means they increase with credits. And you can see your check, okay, the total of my debits, $50,000, equal the total of my credits, $50,000. And then the accounting formula, which is right up here, assets equal liabilities plus owner's equity, and then plus revenue minus expenses. Because remember, revenue and expenses get rolled up into equity, but since we have them here, you're just netting them together. So you can see assets of $50,000 equal liabilities of 0 plus $50,000 of owner's equity plus no revenue minus no expenses. So our accounting formula, our accounting equation equals, and our debits and credits equal. That's what you should do after every one of these problems to make sure you're in balance. Why did I keep going to this? Let me close this. It's just getting in the way now. All right, what is 17th, third, last, and 17th. So by third one you meant the 6th, correct? Okay, good. That is a good one to pick because it actually, you have 3 accounts affected in this one. So Jones Consultants issues check 1002 to Property Incorporated to pay the current month's rent due of $1,000 as well as prepay rent at $1,000 per month for the months of January, December, and January. So there's actually 3 accounts that are affected here. Because, again, when you see issue check what immediately goes off in your head? If you're issuing a check, what are you decreasing from your account? Exactly. Cash. And then Melissa took it one step further. You're going to increase expense because of the rent. So yes, you're hitting, let's start with cash first. You're decreasing your cash. So you're paying current month's rent of $1,000, but you're also paying for December and January of $1,000 per month. So that's $1,000, $1,000, and $1,000. So your total credit to cash is $3,000. Because again, you're crediting cash, decreasing cash for $3,000, because remember, cash has a normal debit balance. Now, you're going to have two offsetting debits because your first one's easy. Current month's rent of $1,000. So if you pay rent of $1,000, you want to debit your rent expense. But you also want to debit an account called prepaid rent for $2,000 right here. And the whole concept behind that is, if you're in the month of November and you prepay for December and January, then you don't want all of that rent going to your expense and being recognized in November, because that means you'd be recognizing December and January expenses in November. Instead, what you do is you put it as an asset on your balance sheet for $2,000, and then when December and January come around, then you do a journal entry to release that money from prepaid rent. You credit prepaid rent, and then you debit expense for $1,000 in December and $1,000 in January. So that's the whole concept behind prepaid rent. But just for our purposes, you paid out $3,000 in cash for rent, and of that $3,000, $1,000 went to rent expense, $2,000 went to prepaid rent. Again, if we look at our debits and credits, $50,000 plus 2 plus 1 equals 53. Credits, 50 plus 3 equal 53. Our assets, 52 minus 3 is 49. And then our liabilities and equity and revenue and expenses, 50 minus 1 equal 49. Yeah, that one is probably the trickiest one of them all. So that's a very good one to pick. So let's take, what are we, 17th and last one. These are actually all good ones that you picked. So the 17th, Jones Consultants performed services to charge account client Speedy Freight in the amount of $3,000. Invoice 101 is issued and receivable in 30 days. So no cash has taken place here. Instead, they performed services to charge account clients. So they're performing a service to someone which they're saying, hey, you can pay us back later. So if you say that to someone, if you say you can pay us back the $3,000 later, what accounts are you going to increase? And it's not accounts payable because you're not looking at liabilities. AR. Yes, that's correct. AR would increase, you would debit it because that tracks who still owes you money. In the problem, they agreed, they performed the services, but they performed it on account, meaning they told Speedy Freight, you can pay us at a later date. So you would debit accounts receivable for $3,000. And then you would credit fees income, your revenue, for $3,000. Because even though there was no cash that exchanged hands, you still performed a service. So you still have to recognize the revenue, but then your offsetting debit is accounts receivable because it shows, hey, they still owe us that money. So when they pay us, then you would credit accounts receivable, and then that's when you would debit cash to increase your cash.
Audio.
All right, so the last one, let's take a look at that. Jones Consultants issues J. Jones check 1005 as a draw for personal use in the amount of $4,000. So if you're drawing money out of the business, what account are you going to increase? You're taking money from the business as the owner. Cash and drawing. Yep, exactly. So you're going to debit drawing for $4,000, because remember, you're going to increase the drawing account to show that Jones took that money out. I know it sounds weird because, again, he's taking the money out, but you're increasing the account. But remember, these two net together, so this drawing account is reducing his capital account. So you debit drawing, and then you would credit cash for $4,000 because, again, he's decreasing cash. Cash is an asset. Assets have normal debit balances, which means they increase with debits. We want to decrease it, so we credit cash. And then before I close this, you can see at the end you have to total your assets, liabilities, equity, and revenue. I'll give you these check figures. So after you're done, you should have 58.7 in assets, 4,000 in liabilities, 46 in equity, 10.2 in revenue, and 1,500 in expense. So those are your check figures. Any questions on that? Good. Hopefully that should get you guys off to a very good start. Yeah, I mean, I'm always usually available. Just during the day, the best way to get a hold of me is email. I really can't talk during the day. More so in the evening, I can talk if you call me. But if during the day, the best way to get a hold of me is just shoot me an email, because I'll usually check my email throughout the day. But yeah, feel free to contact me tomorrow. That's fine. No, I understand. I mean, it's not easy. So that's why I'm here to help you guys. So yeah, like I said, ask questions. Yeah, definitely not alone. Yeah, any questions, just email, call, or text me. But I'm going to go ahead and close this. And then let's hop into our last part of the week's assessment. So let me just bring it up over here. Give me 1 second. So your assessment, this week's assessment is 100 points, and you have 120 minutes to complete it. So you have 2 hours to complete it, and it is 28 questions. So 100 points, 120 minutes, and it's 28 questions. It is all multiple choice. Okay, so stuff. Let me just see one thing. Okay, so stuff you're going to have to know is financial statements. All financial statements submitted to the SEC by publicly owned corporations must include an auditor's report prepared by an independent certified public accountant. Again, prepared by an independent certified public accountant. And know that accountants provide financial information to various parties so they can make business decisions. And there you see there's a lot of stuff from week 1 in here as well. Governmental accountants work on the staff of federal, state, or local governmental units. That's governmental. Financial affairs of business and the financial affairs of the owners should be kept totally separate. So business and personal should be kept totally separate. When you have net income, know that increases owner's equity. Again, net income increases owner's equity. A lot of questions center around your debits and credits, your normal debit, normal credit balances. You know, if this is this, then what increases? So for instance, you know, when a utility bill is paid with cash, you would decrease cash and increase utilities expense. Decrease cash and increase utilities expense. When equipment is purchased with cash, you would increase equipment and decrease cash. So when you purchase equipment with cash, you increase the equipment, you decrease the cash. An increase in revenue is recorded when services are performed for cash or credit clients. So you would increase your revenue when you perform services for cash or credit clients. A sales return or sales allowance is usually recorded in the general journal. To record a payment of an expense, you would debit the expense account because, again, expenses have normal debit balances. The owner's initial investment of cash into the company is recorded as a credit to the owner's capital account because you're recording cash, and if it's the owner's initial investment, you want to credit the capital account. If equipment that costs $4,000 is purchased with a check for $500, then the remainder that is due on account is $3,500. So you would credit accounts payable for $3,500, which is the $4,000 cost minus essentially $500 down payment. So $3,500 credit to accounts payable. After all postings have been made, the totals of the balances in the accounts receivable subsidiary ledger should equal the balance of the accounts receivable account in the general ledger. I'm skipping around here. Let me see. To record the payment on account, you would debit accounts payable. Again, if you pay your account balance, you would debit accounts payable because you'd want to decrease accounts payable, and they have normal credit balances, so you would debit accounts payable. When there are several entries to one or both sides of a T account, the total of those entries is entered in pencil, and this would be called a footing. Again, that would be called a footing. If your accounts payable balance had 85, one second. If it had 8,500 in credits and 4,000 in debits, then your remaining balance would be a credit of 4,500. So if you had accounts payable and it had credits of 8,500, debits of 4,000, then 8,500 minus 4,000, you're left with $4,500 in credits. You can only take the assessment one time. That's the only time. Yeah, you only get one shot. If your service fees account has two credit entries of $1,000 and $1,500, then your balance is $2,500 in credits, because 1,000 plus 1,500 equals $2,500. Know that the normal balance of an account is the increase side. Again, the normal balance of an account is the increase side. Credits record increases in liabilities and owner's equity. The normal balance of a liability account is the credit side. Debits are used to record increases in assets. And you can actually rewrite the fundamental accounting equation. Again, it's always going to be seen, like the way you're going to see it is assets equal liabilities plus owner's equity. And then if you add revenue and expenses, it's plus revenue minus expenses. But you can rewrite it, and you could rewrite it as assets plus expenses plus drawing equal liabilities plus revenue plus capital. But you'll never see it written that way. Again, you could rewrite it to see it as assets plus expenses plus drawing equal liabilities plus revenue plus capital. But again, I hate that question on the assessment because you would never see that in the business world rewritten. You always see it as assets equal liabilities plus owner's equity. You're also given, there are about 3 questions where you're given T accounts, and they have debit and credit balances in them. And you have to figure out the balance of one of them. Like for instance, you know, one of them has cash of 4,000 debit accounts payable, credit of 2,000, accounts receivable, debit of 3, supplies, debit of 1,500, and capital, credit of 9,000. And then you have to figure out what's the balance in the drawing account. So that's just one of them, but that's why it's very important to know your assets equal liabilities plus equity plus revenue minus expenses. So there's 3 questions relating around that. You're going to be given the balances of various T accounts, and then you have to figure out one of them. And each question has 6 T accounts, 5 of which you're given the balances, and then 1 you have to figure out the balance. What else is there? Just skimming through this. Again, there's another question where you're given the balances of accounts payable, cash, equipment, prepaid rent, loans payable, and supplies. And you have to figure out what owner's equity is. So again, that's another one where you're going to have to know assets equal liabilities plus owner's equity. Another question centers around the cash account. You're given 4 transactions, debit of 10,000, debit of 2,000, credit of 3,000, and credit of 4,000. And you have to tell me what is the balance of the cash account. So if I said you have a debit of 10,000 to cash, debit of 2,000 to cash, credit of 3,000 to cash, and a credit of 4,000 to cash, then what's my ending cash balance? Let me just skim through this one more time, make sure I gave you at least hints. Sales returns and allowances. If you return merchandise, the entry that you're going to book is a debit to sales returns and allowances. Again, if you return merchandise, you debit sales returns and allowances to increase that account. That is basically your exam in a nutshell. Just some pointers to it. Like I said, there's 28 questions in total, all multiple choice. It's worth 100 points, and you have 120 minutes to complete it. Any questions on that or anything else? It depends. If you perform like services for cash clients, then you would credit your revenue to increase it and debit your cash to increase it. But that's really, it just depends on the transaction. That's the main one. If you see perform services for cash clients, that's typically when you debit cash, credit revenue. But it doesn't necessarily mean every time you receive cash you're going to hit revenue, because a lot of times you get payments on accounts, which would just be a balance sheet account affecting like accounts receivable and cash. So it just depends on the transaction. Yeah, I'm going to send them the YouTube link, so they will have this, and they will either post the YouTube link or they will download the video and upload it into announcements. But yes, it will be the same lecture in your class. All right. Yeah, thanks. Thanks for everyone attending, and enjoy the rest of your night. If you have questions, like I said, email, call, or text me. But I'm going to go ahead and end the lecture, and I appreciate everyone coming. Yes. Thanks, and have a good night, guys.